and you can see my screen. If you can, please type yes in the question section, or type hello, or type whatever words you want. You can even ask questions, but please show me that you are attending the webinar. I can see people who are online right now, but I don't have any feedbacks from you. Hello. Guys, come on. I think we have some technical issues right now, because I don't see that anybody's typing. Showing screen. For me, it does say that I'm on air, and it shows my screen in a small preview, but come on. Said, Ryan, Rizwan, Mokhtar, Laris, John, guys, I see that you are here online. If you can, please type yes, or type that you can see my screen, so that basically we can proceed. Hello. Guys, I don't receive any feedbacks from you. Do you hear me? Anyways, let me just check one moment. Let me check something. Really quick. In the meantime, guys, please let me know that you're online. I see that many more attendees are joining. Please, anybody from the people who are listening to me right now, if you can hear me, please type yes, or type anything in the question section, so that we can proceed, because as of now, I don't receive any feedbacks from anybody that basically I'm online. The system shows that I'm okay. It's showing the screen. It says, you know, sharing, and the microphone works, but I don't feel like anybody's watching. Come on. Bernard, Ibrahim, John, just, there is a question section. It says chart in the control panel. So basically what I'm asking you to do is to go there and type yes if you can hear me. I'm just asking some people randomly in here. Let me just spare a minute with me, because hello. Once again, guys, I'm going to repeat it one more time. If you can hear me, please type yes, or type hello, or whatever you want in the question section, the chart section in here, so we basically can proceed with the webinar. Because as of now, I cannot, I do not see that anybody's typing anything. And there are a lot of people, at least it says for me, a lot of attendees right now. Let me just entire audience. Okay, all right. Uh-huh. Okay. Mm-hmm. All right. All right. Right now I received some feedbacks from the people. Okay. Yep. Yep. Said. And other people are saying hello. So, all right. So far, so good. Let's proceed with the webinar. I hope that everybody who wanted to join has already made it, because it's 7 minutes past 7 for me, at least for my time, and it's time to start a webinar. All right. Today, the topic of the webinar is called how to read and use candlestick patterns on Forex and other financial markets like stocks. So let's proceed. I'd like to tell that today's webinar is sponsored by HYCM, and let me briefly tell you some facts about the company. HYCM is one of the most recognized names in the Forex industry, boasting 40 years operational history, and is regulated by two of the world's leading financial jurisdictions, FCA and HYCM, with a long track record of providing its global customer base with an outstanding and trustworthy trading experience. HYCM offers clients everything that they need to make informed trading decisions. HYCM has accumulated a large collection of awards since its inception, including World Financial Best Mobile Trading Platform 2017 and Global Banking and Financial Review's Best Forex Broker 2017 as well. Its recognition as an industry leader has helped to evolve as the online broker of choice for traders across the globe. HYCM offers clients excellent trading conditions, great liquidity, and low spreads, delivering a super efficient service with its strongest focus on fast execution and low-cost trading. Always a leader in embracing cutting-edge technology. HYCM strives to stay ahead of industry trends by adopting the latest technologies to cater for its clients' evolving needs. The next step is to read the disclaimer. This may sound boring, but it's a must-do thing. So please read this disclaimer as well. Any opinions made by a personal to the author or may not reflect the opinions of HYCM. All expressions of opinions are subject to change without notice. This material is considered a marketing communications and does not contain and should not construed as containing investment advice or an investment recommendations, or an offer or solicitation for any transactions in financial instruments. HYCM makes no representation and assumes no liability as to the accuracy or completeness of the information provided, nor any loss arising from any investment based on recommendations, forecast, or other information supplied by an employee of HYCM, a third party, or otherwise. Okay, let's proceed with the candlesticks. Let me briefly tell you the history of the candlesticks analysis, how it appeared, and how it evolved in recent times. So the history of candlestick analysis started in 18th century. A Japanese man named Homa, a trader in futures market, discovered that although there was a link between price and the supply and demand of rice, he was trading rice by that time, the markets were strongly influenced by the emotions of traders. He understood that when emotions played into the equation, a vast difference between the value and the price of rice occurred. This difference between the value and the price isn't applicable to stocks today as it was to rice in Japan centuries ago. The principles established by Homa are the basis for the candlestick chart analysis, which is used to measure market emotions surrounding a stock or a traded instrument. Anyway, these charting technologies has become very popular among traders. Candlestick charting is a very complex and sometimes difficult system to understand. Here we get things started by looking at what a candlestick pattern is and what it can tell you about the trading instrument. In order to create a candlestick chart, you must have a data set that continues open, high, low, and close price of any particular candle. The hollow or filled portions of the candlestick is state the body, also referred to as the real body. On this chart, you can see that this is a hollow candle and this is a filled candle. They can be of different colors depending on what trading terminal and which settings you use. But basically, as of me, I use this hollow and seen in the previous webinars. The long line, the thin line above and below the body represents high and low range and is called shadows, also referred as wicks or tails. In here we can see this tail, this tail, this tail, and this tail. Lower and upper shadows for these candles. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the trading instrument closes higher than the opening price, like in here we have, a hollow candlestick is drawn, while the bottom of the body representing the opening price in here, and the top of the body representing the closing price. If a trading instrument closes lower than its opening price, a filled candlestick is drawn, with the top of the body representing the opening price and the bottom of the body representing the closing price. Compared to traditional bar charts, many traders consider candlestick charts more visually appealing and easier to interpret. Each candlestick provides an easy to decipher picture of price action. Immediately, a trader can compare the relationship between the open and close as well as high and low. The relationship between the open and close is considered vital information and forms the essence of candlesticks. Hollow candlesticks where the close is greater than open indicate buying pressure, like in here. Filled candlesticks where the close is less than an open indicate selling pressure. Generally speaking, the longer the body is, the more intense the buying or selling pressure. Conversely, short candlesticks indicate little price movement and represent basically consolidation. So long white candlesticks show strong buying pressure. The longer the white candlestick is, the further the close is above from the open, like in this situation. This indicates that price advanced significantly from open to close and buyers were aggressive. While long white candlesticks are generally bullish, much depends on their position within the broader technical picture, and after extended declines, long white candlesticks can mark a potential turning point of support levels. If buying gets too aggressive after a long advance, it can lead to excessive bullishness. So long blank candlestick in this situation shows strong selling pressure. The long black candlestick is the further the close is below the open. This indicates that prices declined significantly significantly from the open and sellers were aggressive. After a long advance, a long black candlestick can foreshadow a turning point or mark a future resistance levels. After a long decline, a long black candlestick can indicate panic or capitulation. Even more long candlesticks are the Mariposa brothers, black and white. Mariposa do not have upper or lower shadows, and the high and low are represented by the open or close. A white Mariposa forms when the open equals to low and the close equals to high. This indicates that buyers controlled the price action from the first trade to the last trade. Black Mariposa form when the open equals the high and the close equals the low. This indicates that sellers controlled the price action from the first trade to the last trade. The upper and lower shadows on candlesticks can provide valuable information about the trading sessions. Upper shadows represent the session's high and lower shadows the session low. Candlesticks with short shadows indicate that most of the trading action was confined near the open and close. Candlesticks with long shadows show that prices exceeded well past the open and close. Candlesticks with a long upper shadow and short lower shadow indicate that buyers dominated during the session and beat prices higher. However, sellers later forced prices down from their highs, and the weak close created a long upper shadow. Conversely, candlesticks with long lower shadows and short upper shadows indicate that sellers dominated during the session and drove prices lower. However, buyers later they started to beat prices higher by the end of the session, and the strong close created a long lower shadow. Okay. Candlesticks with a long upper shadow, a long lower shadow, and small real body are called spinning tops. One long shadow represents a reversal of sorts. Spinning tops represent indecision. The small real body, whether hollow or filled, shows little movement from open to close, and the shadows indicate that both bulls and bears were active during the session. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Neither buyers nor sellers could gain the upper hand, and the result was a standoff. After a long advance or long white candlestick, a spinning tops indicates weakness among the bulls and a potential change in interception in trend. After a long decline or long black candlestick, a spinning top indicates weakness among bears and a potential change in interception in trends. Let's go to another one. Dojis are important candlesticks that provide information on their own and as components of a number of important patterns. Doji form when a securities open and close are virtually equal. The lengths of the upper and lower shadows can vary, and the resulting candlesticks look like a cross, inverted cross or plus sign. Along doji are neutral patterns. Any doji bullish or bearish bias is based on preceding price action and future combinations. The word doji refers to both singular and plural form. Ideally, but not necessarily, the open and close should be equal. When a doji with an equal open and close would be considered more robust, it's more important to capture the essence of the candlestick. Doji convey a sense of indecision or a war between buyers and sellers with no victors. The prices move above and below the opening levels during the session, but close at or near the opening level. The result is a standoff. Neither bulls nor bears were able to gain control, and a turning point could be developing. The relevance of a doji depends on the preceding trend and preceding candlesticks. After an advance or along with a candlestick, a doji signals that the buying pressure is starting to weaken. After a decline or a long black candlestick, a doji signal that selling pressure is starting to diminish. That's okay. A doji indicate that the forces for supply and demand are becoming more eventually matched, and the change in trend may be near. Doji alone and not are not enough to mark a reversal, and further confirmation may be warranted. After an advance or a long white candlestick, a doji signal that buying pressure may be diminishing and the uptrend could be nearing to end. Various trading instruments can decline simply from the lack of buyers. Continued buying pressure is required to sustain an uptrend. Therefore, a doji may be more significant after an uptrend or a long while candlestick. Even after the doji forms, further downside is required for bearish confirmation. This may come to a gap down, long black candlestick, or a decline below the long white candlestick's open. After a long white candlestick and a doji, traders should be on the alert for a potential evening doji start. Okay, the next one, those are also examples of the evening doji stars when there is a good, good bullish trend, and then a doji forms, which kind of suggests that the buying power is diminishing, and the sellers are going to take action soon. In this situation as well, this is a really nice bullish candle in here, and after that, a doji formed, which shows that the bulls are no longer in control. Long leg dojis have long upper and lower shadows that are almost equal in length. These dojis reflect a great amount of indecision in the market. Long leg doji indicate that prices traded well above and below the session's opening level, but closed virtually even with the open. After a whole lot of yelling and screaming, the end result showed like a little change from the initial opening. The next type of dojis is dragonfly and gravestone doji. Dragonfly doji form when the open, high, and close are equal, and the low creates a long lower shadow. Thus, resulting candlesticks looks like T with a long lower shadow and no upper shadow. Dragonfly doji indicate that sellers dominated trading and drove prices lower during the sessions. By the end of the session, buyers resurfaced and pushed prices back to the opening level and the session high. The reversal implications of a dragonfly doji depends on previous price action and future confirmations. The long lower shadow provides evidence that the buying pressure, but the low indicates that plenty of sellers still loom. After a long downtrend, long black candlestick, or at support, a dragonfly doji could signal a potential bullish reversal or bottom. After a long uptrend, a long white candlestick, or at resistance, the long lower shadow could foreshadow a potential bearish reversal on top. Bullish and bearish confirmations is required in both situations. So basically, it's not simply enough to see a doji candle and start to trade Basically, those are reversal candles, and it's not enough to trade against it, to start trading against the trend right after you see a dodgy candle. So basically, what you need to do is you need to have a confirmation on indicators, on moving averages or levels or whatever type of confirmations you use. This is basically an one evidence or an indication that something is wrong with this trend, and you need to check it further. Right. Basically, let's move another one. The gravestone doji from when the open, low, and close are equal and the highs create a long upper shadow. The resulting candlesticks look like an uptrend or a letter T with a long upper shadow and no lower shadow. The gravestone doji indicates that buyers dominated the trading and drove prices higher during the session. Like the price started from here and went all the way up. However, by the end of the session, sellers resurfaced and pushed prices back to the opening level, to here, and to the session's low. So basically, that's the indication that the bullish trend is changing, or at least a correction is starting. Before turning to a single from a single to a multiple candlestick patterns, there are a few general guidelines to cover. So a candlestick depicts the battle between bulls, buyers, and bears, sellers over a given period of time. An analogy to this battle can be made between two football teams, which we can also call the bulls and the bears. The bottom, the intersession low of a candlestick, represents a touchdown for them. So a bear in here, you saw the bullish candles. Those are the examples of the bullish candles, single ones. But later on, I'll explain how even to adopt multi candlestick patterns in to convert it into a single bullish candle and to see those candles on chart and to use it. And so bears on the top in here we see bearish candles. The examples, they are basically look the same, but if those ones, the bullish ones, they were hollow, the bearish candles are almost all of them are filled. Okay. Those are the examples of the reversal candles. So basically, when you see those candles on chart after a strong trend, you have to start checking the situation yourself, and you have to be on alert that possible trend change can happen in the meantime. So one of the founder of the theory of candlesticks, Greg Morris, in his book Candlestick Charting Explained, notes that for a pattern to qualify to a reversal pattern, there should be a prior trend to reverse. Bullish reversals require a preceding downtrend, and bearish reversals require a prior uptrend. The direction of the trend can be determined using trend lines, moving averages, peak through analysis, or other aspects of technical analysis. A downtrend might exist as long as the trading instrument was trading below its downtrend and the trend line. Below the previous high or below a specific moving average. The length and the duration will depend your individual preferences and on the time frame you trade, and also on the trading strategy you use. So let's go to one of the most important and really helpful single um, reversal candlesticks. I would define those two candlesticks as hammer and hanging man. There are different names of those candles in the internet. Some call it not hammer but sword, or mm, even differently. But basically, I prefer to call it a hammer and a hanging man. The hammer and hanging man look exactly alike, but have different implications based on the preceding price action. Both have small real bodies, black or white, long lower shadows and short or non-existent upper shadows. As with most single and double candlestick formations, the hammer and hanging man require confirmations before action, as always. The hammer is a bullish reversal pattern that forms after a decline. In addition to a potential trend reversal, hammers can mark bottoms to support levels after a decline. Hammers signal a bullish revival. The low of the long lower shadow implies that sellers drove prices lower during the session. However, the strong finish indicates that buyers regained their footing to end the session on a strong note. While this may seem enough to act on, hammers require further bullish confirmation. The low of the hammer shows that plenty of sellers remain. Further buying pressure and preferably an explaining volume is needed before acting. Such confirmation could come from a gap up or a long while candlestick. Hammers are similar to selling climaxes. The heavy volume can serve to reinforce the validity of the reversal. The hanging man is a bearish reversal pattern that can also mark a top or resistance level. Forming after an advance, a hanging man signals that selling pressure is starting to increase. The low of the lower shadow confirms that sellers pushing prices lower during the session, even though the bulls regained their footing and drove prices higher by the finish. The appearance of selling pressure raises the yellow flag. As with a hammer, a hanging man requires bearish confirmation price action. Such confirmations can come as a gap down or a long black candlestick on heavy volume. So basically, those okay, those were hammer and hanging man patterns. Let's go to inverted hammer and a shooting star. So the inverted hammer and shooting star look exactly alike, but we have different implications based on previous price action. Both candlesticks have small real bodies, black or white, long upper shadows and small or no non-existent lower shadows. These candlesticks mark potential trend reversals, but require confirmations as always. The shooting star is a bearish reversal pattern that forms after an advance and in the star position, hence its name. A shooting star can mark a potential trend reversal or resistance level. The candlestick forms when prices gap higher on the open, advance during the session, and close well off their highs. The resulting candlestick has a long upper shadow and small black or white body. After a large advance, the upper shadow, the ability of the bears to force prices down raises the yellow flag. Uh, to indicate a substantial reversal, the upper shadow should be relatively long and at least 2 times the length of the body. The bearish confirmation is required after a shooting star and can take to form of a gap down or long black candlestick on heavy volume. The inverted hammer looks like a shooting star but forms after a decline or a downtrend. Inverted hammers represent a potential trend reversal or support levels. After a decline, the long upper shadow indicates buying pressure during the session. However, the bulls were not able to sustain this buying pressure, and prices closed well off and their heights to create the long upper shadow. Because of these failure, bullish confirmations is required before action. An inverted hammer followed by a gap up or a long white candlestick with heavy volume could act as a bullish confirmation. Okay. So far so good. Let's start to take a look at the bullish candlestick formations. Or what formation is? A formation is basically a combination of two or even more candles, which suggests basically market reversals. Usually they are used in order to foresee a change in trend. Why in this picture there are no just two candles, but there is a line you see, and the combination of those two candles in one candle as it is. Like the opening price was here of the first candle was here, or we projected to here. The closing price was here, but then the opening price of this candle was here and the closing price was here, and we project simply the opening price of the first candle and the closing price of the second candle, and the highs and lows we simply connected in here. It's not from the first candle but from two candles, but it appeared that the situation in here is basically changing. So these two candles, if two of them combined, they make one candle in here. And this is a really, really nice bullish reversal candle. If I scroll back to list of bullish reversal candles, some of you are asking right now, okay, I don't have another, all right. Okay. So basically, I see that some of you are asking questions, but all right. Okay. I see that some of you are asking questions. I would basically tell you that the questions would be asked later, and I would happy to answer these questions a bit later. So as of now, you see that the bullish candlestick formation in here can be made in one simple candle, and this candle you can see right here, and this is a good candle. The bullish engulfing pattern is a second day long body candlestick that opens lower but closes higher than the prior day small body candlestick. This shows an engulf pattern by the second day's candlestick to the previous day's candlestick. This formation is the equivalent of the bullish K reversal in the candlestick chart. The bullish engulfing pattern is a strong bullish if it's occur after a significant downtrend. The signal is to reverse for buying. These bullish engulfing patterns reflects a general change in the market sentiment and the volume trends to be high. Traders must be aware that it is common for a neutral period to immediately follow this formation, because the market needs to digest the large one-day activity and reevaluate the new price levels. The next pattern is Harami pattern. A bullish harami is a candlestick pattern in which a large candlestick is followed by a smaller candlestick whose body is located within the vertical range of the larger body. The bullish harami is a downtrend or bullish candlestick engulfing a small bullish candlestick, giving a sign to a reversal or downward trend. Since the bullish harami indicates the bearish trend may be reversing, it may be good time to enter into a long position. Okay. Once again, you can see that basically the bullish candlestick formation called harami can be combined in one candlestick, and this candlestick is a good bullish reversal candle. So my advice would be to, in order not to remember, I will show you a lot of bullish candlestick formations on the slides below, but I would not advise you to learn any particular one of them, but instead use this method of combining two bullish candlestick formations in one, and to use it on your benefit. So you remember like 10 bullish candlesticks, reversal ones, and then when you see some combination, you simply say, okay, I combine those two and make one out of it, and I trade with the help of it. All right. The next confirmation is the bullish candlestick formation is called doji star. So in here it can also be combined like that. But in this situation, we see that there was a good downtrend in here, and then a doji star was formed at the bottom in here, which shows that the selling pressure is reduced, and the buyers are thinking of turning the trend up. So that's why even if we combine those two, we see a big bearish candle. But when you say doji, that's a sign to at least not to take action, but at least to be warned that this candlestick formation is a reversal one. So in here, the bullish, this confirmation is called Hoshi. It's quite simple to the previous one with a doji, but this candle look a bit different. So it's also say that show that there was a strong selling pressure from sellers in here, and there was a small candle appearing in here, and this small candle basically started in here, but then the bulls pushed it a bit above the low of the candle, and also it shows that the selling pressure is diminishing, because this candle was a really good bearish one, but instead this one, it's a small candle, and it shows that the buyers are thinking of turning trend upside down. This is another one, it's called Hoshi. The main idea of this, I would honestly say that it's quite hard to find a classical Hoshi pattern on the chart, because usually there are small shadows, upper and lower shadows, and in here you cannot see any shadows. So what's basically we can see here is that it started from here, it went all the way down, Then there was a gap formed, right? But the closing price of this candle was on the same level as the closing price of the previous one. So that means that sellers could not push the price lower than this level. First, it indicates a strong level, and second, it indicates a possible future reversal. The bullish candlestick formations is the pricing line. Okay, I do receive some questions in here, but guys, once again, I would tell you that I'll answer those questions a bit later after the webinar ends. So this formation is called a dark, it's a pricing line formation, and this shows a sharp reversal in the previous trend. So basically, there was a bullish reversal in here. The good bearish candle, this long one, was broken by this really nice bullish candle. It started from the gap, but then after making a bit lower level from here, the bulls are simply pushed the price much higher, and as a result of combination of those two candles, a good reversal candle was formed. So the formation is called pricing line. Another one is called meeting lines. It's basically the same situation, but the gap was higher in here, from here to here, right? The gap was higher, and the closing price was on the same level as the bullish candle was on the same level as the bearish candle. So basically, as a result, it also was for a good bullish candle. The candle looks bearish, but when you see it on the bearish trend, this candle suggests that the possible bullish reversal is possible. So bullish candlestick formations continue, and we see a separating lines in here. You see that basically this candle doesn't have any shadow, and it also suggests that the previous bearish trend has come to an end, and the really nice bullish candle was formed if you combine those two. So far so good. Let's go to the bearish candlestick patterns. It would be almost all the same patterns but reversed. Let's discuss the dark cloud cover pattern in here, and the rest I'll simply show you. So the dark cloud cover is a bearish reversal candlestick pattern whereby a black candlestick opens above a white candlestick's close and below its midpoint. The bearish engulfing patterns or bearish Susumi like candlestick, this one is a second day long body candlestick that opens higher but closes lower than the prior day small body candlestick that shows an engulf pattern by the second day's candlestick to the previous day's candlestick. This formation is the equivalent of a bearish key reversal in candlestick chart. Bearish engulfing pattern is strongly bearish if it occurs after a significant uptrend. The signal is to reverse to selling. The bearish engulfing pattern reflects a general change in the market sentiment and the volume trends to be high. Traders may encounter a neutral period immediately following this formation because the market needs to digest the large on-day activity and reevaluate the new low price levels. So this one is a bearish Atikubi bar. It's two different types of it, but basically the situation is almost the same. You see that the bearish candle was stopped by the good bullish one, In the end, we see the bearish formation, but because of this one, we can basically think that a possible trend change is coming. This is a Tasuki bar, it's called. You see that in here the price was closed, the gap was formed, but then the bulls are trying to take over control, and in the end this candle forms bearish meeting lines. In here you can see, right? So bulls were stopped by this small candle, which was formed with the gap and closed on the same level as the previous candle. And doji star bearish is when a doji appears on the bullish market. In here it forms this model. Okay, so far so good. I would like to analyze a chart with the help of those patterns and answer your questions if you have any. Okay, let me just open the trading terminal in here. So basically, what I would like to tell you is that I prefer to analyze, I prefer to use those candlestick patterns only on daily, 4-hour, or 1-hour time frame. I would not advise you to use the candlestick patterns on 15-hour time frame, 5-minute time frame, or 1-hour time frame, because those time frames they are not really relative for the candlestick analysis, as I think. Because if you're a scalper and trading on 1-minute time frame, it's okay. But the candlesticks, which are which you can see on 1-hour time frame, they are basically random. Those candlesticks they show how price moved in 1 minute, and basically it does not have that much power as the candlestick analysis on daily time frame has. So let me just jump on the chart and see how it works. In here, right? We saw. Let's analyze it from here. We saw a good bullish movement, right? But after this movement, such candle appeared. This is not a doji candle. This is not a doji candle, but it's a bearish candle. And after this candle appeared, a correction started. So the market basically spent the next week, it's a daily time frame, which means 5 candles is 5 days. It spent 1 week in this range. So after a good bullish movement, and this candle appeared, the correction started. Then the bullish movement continued, and then boom, and we see a good reversal candle. Yeah, some say that's a sword candle, or it's a type of a doji candle, right? And it shows that the bullish market, it was reversed from highs from here to here, and then correction starts. The correction goes all this way in here, right? And then market reverses. Market went down, and boom, a doji candle was formed, a small doji candle, which showed that the market, there is a possible reverse. The market goes up, then this formation, right? It's called a consumption formation at some point. This formation showed, and the market reversed. In here, as we have already discussed, it's a really flat market in here. So it's on flat market. A lot of dodges would appear, a lot of small candles would appear. I would not recommend you once again to use this candlestick analysis when there is a really flat market. When you see that the market is basically moving around the moving average, and you see that this is a 50 period moving average, and the market is moving basically for ups and downs, ups and downs, ups and downs, ups and downs in here. So it's not really relevant to use these candlestick formations when the market is so flat. But let me just open this one, this chart, right? We saw a really nice bullish movement, and then boom, like a gray appeared. Also a reversed hammer, it's called, right? A reversed hammer in here, or also some may say it's a sword, and it's a sign that the really nice bullish trend has come to an end, right? We need to receive a confirmation in this case. You see I have an RSI here from the previous webinar, and the RSI is going from the oversold zone to a normal zone, which is also a sign that there is a potential trend reversal. And boom, the trend reverses. Okay? So basically it works like that. We can analyze another pair, like in here. In here, it's the same basically. You see that there was a good bullish trend in here. Boom, a reversed hammer appeared. It corrected. The bullish trend continued. Boom, a reversed candle appeared. If you combine those two candles, you would receive a really nice bearish candle, and it corrects. It continues, and a doji candle, even three doji candle. You see, in here it was a good trend and weak doji, and it goes down all the way. In here it corrects and then goes down as well. So let's go to CHF. Oh, with the CHF, it's in here the reverse. There was a good bearish trend. Then you see this consumption situation appeared. If you combine those two, you would receive a doji. It goes up. It continues the trend, and once again, you see, if you combine those two, you would receive this a hammer candle or a reversed hammer or a doji also candle, and it goes all the way up. So in this situation, it's not just a signal. If you see this situation, it's not a signal to immediately buy, but you can see a confirmation. In here as well, you see that this model appeared in here. On this candle, a small one, we saw that the RSI is going from the oversold zone, which can be a confirmation. And we can open basically a position from here with a take profit at least on the moving average. At least on the moving average. How many pips is there? Like 200. Around 200. Okay? In here, there is a really nice bullish trend. It's a really nice bullish trend. But if there would be a bearish candle appearing in here, and RSI is going from the oversold zone, it would be a possible good reversal signal to sell this car. Not right now, of course. It's a bullish market. No sells as of now, but probably in future we can consider selling it after a bearish candle would appear. Well, like this one, probably like this one, like this formation in here. Okay. As well on the British pound. On the British pound, it's also like that. You see, there was a bullish trend, boom, this model appeared, correction, bullish trend, Oh, and bearish candle appeared, correction, going down a bit, right? In here, all the way up, bearish candle appeared, correction. In here, bearish candle appeared, correction, and so on. So basically, it works like that. So you take a look at the market on daily, 4 hour or 1 hour time frame. That's honestly that's my point, but it does make sense for me because using candlestick analysis on 1 hour time frame, at least for me, it doesn't work. Probably for you it can, but I do not consider it worth it because on 1 minute time frame, the volatility is tremendous and it does not represent what's needed to be represented in this one candlestick. It's not enough information in 1 minute, as I think. And on daily time frame, it works really nice. Probably on any currency pair, or not just the currency pair, but stocks as well. This all came to Forex from stocks market analysis. We can just take a look at another currency pair like this one. Let's see. Yep. Okay. A bearish market. This candle appears. We combine two of those candles and it goes all the way up, right? When it corrects, okay, this is a correction with the bullish trend in here, then boom, small candle appeared, doji appeared, and a correction started in here. This is more like a flat market, so it's not worth to analyze it. Like in here as well, there was let me show you the bullish trend in here. Two dojis appeared, it corrected. Okay, like in here, this is also nice. A small trend, maybe it wasn't a trend. Okay, a trend started from here, it went all the way up, and then you see what appeared. Two of those candles in here. If you combine those two, you would receive an amazing gravestone or a doji with a long shadow in here, and the trend changed. Okay. Like in here, this is a really nice example of a doji candle, a small one. It's not a classical doji, right? The open price was 150.56. The closing price was 150.76. So basically, it's 13 pips different. It's not the same level, but when you see those movements, sharp ones, you can consider that it was a doji. And there was a good bearish trend, a doji formed, and immediate reversal. You see? In here. This is more like a flat pair. It's Australian dollar, New Zealand dollar. Let's go to GPY. Like in here as well, you see, the bearish trend was stopped by a hammer. It corrected, continued in here as well. Two small candles in here, so it basically fall. Then a small candle appeared in here as well, and then it went all the way up. You see? So it's basically how you use this candlestick analysis. Once again, when you use candlesticks on charts, when you try to analyze the market with candlesticks, in order to build your trading system and in order for your entry to be successful, you need to take a look at the confirmations as well. So in order to trade, you need some confirmations. Like in this case, it's RSI. You can basically skip RSI, just delete it. It's Williams. And you can basically use the confirmations as the, let's say, moving averages can also be used as the confirmation levels. Some other indicators like stochastic, MACD, or trend indicators, like we started on the first webinar, can be used for confirmations. It's not necessarily it can indicators. Some people use like levels, like you see that let's say 105 was a really strong level for this currency pair. Like it went all the way down to this level. It broke it a bit. It was a fake testing, and then two dodges formed. You see, two dodges formed, and the market reversed. So those levels can be used as confirmations as well. It's not necessarily an indicator, but I believe if I build, let's say, okay, an oscillator, let's go for stochastic with standard parameters. Yep, it's an oversold zone for stochastic as well. You see, that's an oversold zone. That's another confirmation you have here in order to enter the market. If we build let's say not a stochastic oscillator, but let's go for let me just see MACD. Okay, in this situation the lines crossed in here. It's separated from it's a bit late, but still it gave us a signal to enter not here, but you know, a bit late in here, but but on this candle. Okay, if we built another indicator, it would also be a good confirmation for us. So my advice would be to confirm all the entries which are generated by the candlestick analysis with with something else, with other trading instruments, including levels, including indicators, including moving averages, including trend lines, and other instruments in order to increase the success in your trading entries. All right, guys, so far so good. That's it for today, and I'm ready to answer your questions. Mm-hmm. Okay. All right, so far so good. I believe I've answered all your questions right now. And all right. You don't have any questions for now. So we're gonna wrap this up. I have a quiz for you as always. The link for the quiz is here. You can use this link to go through the quiz, and after you complete the quiz, you would receive a certificate from HYCM that you've successfully visited the webinar, and you have learned the information that was provided, and you can share this certificate in social media. You can keep it and enjoy. And thanks everybody for visiting webinar. Thank you very much. I hope to see you next week, same time, same day. We're gonna be discussing the reversal levels. the resistance levels and possible market reversals together with you. So in order um, to learn this topic, please join our next webinar on Wednesday, 4 p.m. GMT. And thank you very much for visiting. Have a great week. Bye bye.